Hey guys, this is Jenny Algretti, and
Jorge Aldrete.
we wanted to do an episode of the Real Tribe podcast so we could talk to you about different loan programs so you can educate yourself, or if you're a client, you can learn more about your opportunities as well. So, so we are going to be specifically talking about loans for cross-country mortgage. So if you're watching this and you have one of our lender sponsors, feel free to reach out to them afterwards and ask any questions. If you're a client, you can email us as well at thehive.com. So let's hit send.
One of the programs that would love to highlight today is the 7/6 ARM which is an adjustable rate mortgage program. It's nice to have them back because they've been out of the market for quite some time because rates were pretty high, and now they're making a comeback. And it's been phenomenal, especially with a lot of our jumbo or big loans. That's where you see the big difference. The other day, we were able to lock the rate for one of our clients that is purchasing a jumbo loan, which is a $1.1 million home, 20% down. So the loan is going to be above.
Basically, conventional loan limits have a max loan amount that you can have. And once you have to go above that loan amount, then it's called a jumbo loan, which changes how much down payment you can have, et cetera.
That is correct. And there are programs like California and other places that, because the loan amounts are much higher, they have a different cap with a high balance conventional loan, which allows them to still price it at conventional. But in this case, the 7/6 ARM has been pretty aggressively priced because it basically you have the same rate for 7 years, and it's a lot lower. It's about half a point, 0.5% interest.
Did he come to you because he wanted a lower rate, or did he come to you because he also wanted a different down payment?
The client was looking to purchase. He just wanted to put 20% down. The builder's lender was telling him, hey, you can put a little bit more and be on the conventional side. But he didn't want to let go. He wanted some extra money in his pocket. So we gave him all the options, right? Whether here's what it looks like if you just did 20% down, stay at a jumbo loan amount, or if you go into a conventional and put more money down. Thank you. Appreciate it. I didn't even say anything right there, but
Jumbo.
apparently it worked. Jumbo. We as lenders love the word jumbo. This program is making a comeback. It's priced aggressively here with Cross Country Mortgage. If you are out there looking and shopping for a loan, whatever it is, make sure wherever you're at, you reach out to us or any cross country lender or if you don't know one, let us know. If you're in a different city, state, we do them nationwide, and get in touch with them because Cross Country Mortgage right now is doing 1 out of every 33 homes is being financed by Cross Country Mortgage.
I'm assuming that means it lasts for 7 years, but in the 6th year, does it go up?
No. So it's going to be 7 years at the same interest rate, same payment. And you can do either fully amortized payment or you can do interest only. Depends on how much you want to save, basically. After 7 years, the rate is going to adjust. And then
Every 6 months.
And then so it adjusts at that point. There's an adjustment. And then after that, every 6 months, that's what the 6 means, is every 6 months. It can adjust as well, depending on where the market's at.
I like this. Therefore, it makes sure that your rate doesn't jump up so you don't feel a huge slam in your mortgage payment. Most people don't keep a mortgage for 30 years. Most people move after 7 years, average.
Yeah, typically. And that was one of the conversations I had with the client, was the fact that he was debating whether to go 30 years or do the 7-year ARM. And after a further discussion, I was telling him most people either refinance or they sell their home within 5 to 7 years. Historically speaking, and with the way rates are today, in hopes that rates are going to drop within the 7-year mark, then we're able to refinance them at the same or lower rate for the fully another 23 years, 20 years, whatever. We'll modify it according to how he wants it, all the way up to 30 years if he wanted to go back to the 30-year mark.
I think the biggest thing that I would gain from this is, if I was a buyer, is that when know that if you're working with a builder's lender, you can go outside and get other quotes. But that's certainly your right to do it, to make sure that you're getting the right loan product, right? So don't just assume that's because what they're offering you, that's your only option. I would also make sure when you're talking to a lender that you express what your goals are, because if your goal is to keep cash in your pocket, then that's going to change the loan product that you potentially do, or whatever your goal is. I just encourage you to say, these are the things I want, or what things should I be considering? so that you can get more information, make the best decision for you.
And that's the conversation that I was having with the client is what are your mortgage needs and your mortgage goals? What's the plan from here, 5, 7 years? I told them, I was like, what is the plan with you? Are you planning on in here for quite some time? And it was the first house he was buying in the area. So it's great for the family right now, but I don't know where we're going to be 5, 7 years down the road. And this program just made sense for him. He was saving somewhere in the vicinity of about $370 a month. So that over 7 years, that's almost $30,000 in interest that he's not going to have to pay.
Yeah. You can take that money and you can put it somewhere else. You can invest it, make money off of it, etc.
That's exactly right. And again, last month, we ended up doing a $2.2 million deal on a 5-year arm, right? As well. The client was like, hey, 16 months from now, it gives me an idea what I'm going to do, whether I'm going to keep this house or refinance it if rates are lower. But it was a win-win situation for him because he was saving a ton of money. We have the 3-year, 5-year, 7-year, 10-year arms. We have interest only. We have fully amortized. We have a whole different line of products that we're going to be talking about constantly in our podcast.
I know what interest only is, but what's the difference between that and amortized?
The interest only is you're only paying the interest. That's it. You're not paying principal into the loan at all during that time frame. You're only going to pay the interest. Your payment ends up being even cheaper. Not only are you going to get a lower rate than the 30-year, but then you're only paying interest.
You get more money in your pocket that you can use to make money elsewhere, but you aren't paying down the principal.
The principal is going to be the
The
same.
only thing you're going to get is from just the market.
From the market. Right. Yeah, exactly. And like I said, if you're on the in the market to buy, if you're in the jumbo market as well, right now, arms are going to be one of the best options for you.
If you're an agent and you want help with your coaching and your marketing, you can come to us at realtorhive.com. Just click join now and say that you heard about it from Jenny. And if you need help with a loan product, then you can email the Jen at therealtorhive.com and we'll get you in touch with the right lender.